Once upon a time, there was a frog. He fell into a pot of water that was set on a stove for boiling. Now, when the frog fell into the pot, he realized that the water is heating up. But he was comfortable. The water was lukewarm, and his body had adjusted to the temperature of the water. So he didn't feel like leaving. After a while, the water started heating up a little bit more. But so did his body temperature, and he got adjusted to it, and he decided to stay. Eventually, the water reached its boiling point. The frog wanted to jump out now because it was not at all comfortable. But he realized that there is no energy left in his body because his body had used up all the energy to try to adjust its body temperature. The frog died in the boiling water. Hello, folks. My name is Neil, and today we are going to talk about adjustments, averaging out, stop losses, and what's the best time to jump out of a pot of boiling water. In one of my previous episodes, I talked about stop losses and that you should get out no matter what. While I said that, it's not really a rule, and it's not really a bad idea to average out your stop. But when should you do that? And when should you jump out of the pot or take the stop loss trade and get out? Let's take an example today and see what would be the best time to get out of a stock using a stop loss. Now, what you see on the screen is Nifty. Let's take an example of Maruti. And this is a monthly chart, so let's go to a daily chart. Now, I take daily chart because I'm looking at it from a swing trader's perspective. So I'm expecting my returns to come back from a few days to a few weeks. Right. Now, if you analyze the chart, the stock started rising from here. It hit a bit of a drop, and then you see that it started rising from here again. And since I don't know what date is this, about 28th of June, the stock has been consistently falling. Now, if you've seen my previous episodes, I have talked about demand zones, supply zones, a couple of indicators like the Bollinger Band and the RSI indicator. You see all of these indicators right here. So what I'm going to do is I'm going to create a demand zone. I see that there is a basing candle here where the wick is longer than the body. I'm going to treat this as a demand zone simply because after this point, the stock started rising and it was a good strong rally. From there, it did hit here. It did come down. I see another basing candle here. If I treat this as a demand zone, uh, it would not have been a good idea simply because, well, the stock did not react from here one bit. Uh, but that's because this is not really a proper demand zone. It's this demand zone that it reacted to, if you notice, right? So there was a demand zone here. The stock did come down. It reacted from here and started rising again. Having said that, this demand zone was taken out. And if you notice, there was a slight bit of reaction at this point in time. It did touch this, move up a little bit, and then went down a little. And then it disregarded the demand zone and went down further. Now, let us assume that we are on this date of, I don't know, this is 13th August 21 in this candle. I'm talking about this particular candle. This is 13th August 2021. Let us say that I am in 13th August 2021 here, and the stock is going down, and I see this particular demand zone, right? So I plot my entry, assuming that it's going to breach the Bollinger Band, and the RSI indicator was decently low at that point. I don't know. Let's take a look at what's the RSI. Well, it was at 41, so I'm assuming that once it hits the demand zone, it would get to somewhere around 30. I would plot my entry here because I'm expecting the price to go back up from here, and I take a stop loss, right? And and what do I do? And I have a target of somewhere around here, which is 7,709. which was hit on, I don't know, this was 28th June, right? It was hit on 28th June, so I'm expecting it to go back up there. But what happens really? We go a little bit to the right, and we see that the price came down. It touched the demand zone. I was happy on the next day because it touched the demand zone and reacted. But it did touch my stop loss. What should I do here? Should I, when it hits the stop loss, should I take the trade? Well, I didn't get much of a chance here because it was possible. I don't know the exact time when it hit the stop loss, but I was considerably happy that the price went up, and this is a fictitious scenario. But on the next day, I see that the price fell again. It reacted again, and then it went back into going down, right? So, uh, you know, after the initial reaction, it continued to fall. Now, there are many reasons why a stock could disregard a demand zone. It could be the general market forces. It could be news about petroleum or the auto sector or new taxes levied on the automobile sector or any number of reasons. But the market decided that the price will continue to go down. Now, at this point, what should I do? Well, I was expecting the price to react from here and start going up. If it does not do that, I'm not supposed to average it up. I am supposed to take the stop loss because I took the trade, you know, and I hit stop loss. I should get out immediately, right? But should I do it every single time? Should I get out of a trade every single time it goes down below the buying price? When do I average out my buying price to improve my share cost, right? Let's cover that. So let's assume that that I saw the trend going up. Now we are here somewhere, okay, somewhere here, okay. I saw the price went up, and then it started going down, and I am in 16th June 2021. Today is 16th June, assuming, right? And I see that the price is coming down, and it's coming down, and I have set this demand zone. I have plotted my entry and my stop loss over here. And so what happens? The price comes down. The lowest point of the price is 6821. Okay, let's adjust our entry for example. This is just an example I'm giving you, right? So let's say that let's say that I get my trade at 6821, right? And okay, let's say 6837, right? And let's say what happens the next day? The price start going up. So I'm very, very happy, right? I see that the demand zone worked. The price came down, it hit, and the price started going up. Now, after reaching to 7709, which I did not set the target, by the way, let's say that I had set the target here at somewhere around 8226, right? Because I was assuming that it will go up until then, but it did not go up. It went all the way till 7698, and from there it started its descent, and it kept on falling, and it kept on falling, and it kept on falling, and it kept on falling. Now it goes below the demand zone. Should I take a stop loss at this point in time? I say that you don't. In this particular case, your trade did work. Unfortunately, because of the market forces, it started going down, right? It wasn't the best of the trades, to be honest. Maruti is not a stock that I am betting on for the long term. It is a momentumizer for me. I do feel that swing trading, Maruti works really well because it goes down and up and down and up. But if you look at the monthly chart, it's not doing an amazing job for last many, many years now. Okay, 1, 2, 3, 4 years now. Okay, it's been in range for a while now. So I don't think it's a very good stock when it comes to long-term investing. But having said that, from time to time, like in 2008 and like in 2020, the entire market falls. Ideally, I should be able to predict that the market is going to fall and get out of here and then get back in somewhere around, I don't know. The price could react here, could not, I don't know. I can't really truly predict about Maruti. But it's a decent price to buy if the RSI is below 33, it is touching the lower Bollinger Band. And if I have a matching demand zone somewhere in the higher time frame. Ideally, this would be the best price to buy. I could go to the daily chart and so on. My point is, the best thing to do would be to get out when the markets are high, if you're predicting a crash, and then get back in the portfolio. But if you don't get that opportunity, and if the price falls and you're making a loss, it's not a bad idea to average it out if it is a long-standing stock, right? So, to summarize, if you take the trade expecting it to turn, and if it does not turn and hit stop loss, take the stop loss, get out. If you've taken the trade long time back, if you hold the stock for a really long time and the price has been falling, and if it is a good stock from a fundamental standpoint and from a trend analysis standpoint, if it touches your cost price and goes further down, it's okay to average it out. But be very, very careful when it comes to averaging out stock prices. You must be sure that the stock will eventually go up in the long run. You must be. Otherwise, it's always a good idea to jump out of the pot the first opportunity you get. That's all I have for you folks. I'm always looking for feedback. Do talk to me. Otherwise, I hope we make a ton of money out of the stock markets. All the best. Have fun.